The E-mini had an extremely strong day on Friday, so it's a bi-climax day. And the day after a bi-climax day has a 25% chance of being another very strong bull trend day. It's probably less than that in this particular case because the market is so overbought on the daily chart and 60-minute chart. Might get one more push up, so 1, 2, and 3. The day after a bi-climax day, 75% chance we're going to have at least a couple hours of sideways to down trading that starts by the end of the second hour. We have a spike pullback channel, and even if we go up here, we'll probably come somewhere back around here and continue the trading range that started on Friday. I think the most interesting thing is this 60-minute chart. This is the current bar, and the last time the market hit the moving average was here, and that was 70 bars ago. And the point about that is it's a streak of 70 bars every low above the moving average. And streaks, theoretically, the market never has to touch the moving average. It could stay above it forever. But that's never happened. And therefore, every streak ends. And this is already the longest streak probably in the past few years. And therefore, it should end today or tomorrow. And it ends by the low of a bar being below the moving average. It doesn't have to be much, just one tick below would end the streak. We got near the moving average here, 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 but did not get below it. But today or tomorrow, so sometime in the next 14 bars, the low of a bar is going to be below the moving average. And we can get there two ways. We can go down sharply, big bear trend day, or we could simply go sideways like this. So strong bull trend sideways. If we went sideways for another couple of bars here, the low of a bar would have been below the moving average. So if we simply go sideways for a couple of days, we will end the streak. We'll have a low below the moving average. Then the other streak is on the daily chart. What do you notice? Okay, today's the 11th day in a microchannel, every low at or above the low of the prior bar, and that's unusual. You can get more, you can get 12, 13, 14, 15, but you don't get 20 or 30. So we're at the outer limits of the market going without a pullback. A pullback simply means today's low is below yesterday's low. There's something right here. You can see, if I zoom in on this, you can see they still have yesterday on the chart. See right here? This is Friday. The big bull day is Friday. And we have the tiny day, that's yesterday, and this is today. They will remove this day at some point today. That always happens after a holiday. TradeStation will show on the daily chart the holiday day, and then they'll remove it. There was some trading yesterday in the Globex market in the morning, and they will remove it. And so this bar is going to disappear. I'll refresh now and see if this goes away. No, it's still there, but that will be gone within a couple hours. If you look at the market this morning, on the 5-minute chart, there were a bunch of bars here from yesterday morning, and TradeStation removed those bars. On the 60-minute chart also, we tried to get a double top here, and we broke out a gap and a very strong trend. Double tops, you're looking for a measured move. The bears wanted to break below the neckline, so double top neckline, and then they want a measured move down. And the bulls want the market to break above the double top and then get a measured move up. And you can see on Friday, we went above the measured move and reversed. And today we're testing that measured move again, and so far we are reversing. Most resistance in a strong bull trend is minor. It's a speed bump and not a brick wall. So the market often stops or pauses at resistance, but it usually breaks through it. Weekly chart over here, we had a measured move up from this low to this high, and you can see sideways for about 8 bars trying to get through it, unable, but we did break through it. So instead of a brick wall and the market reversing, we broke through it. When the market's in a strong trend, a strong bull trend, all resistance is more of a speed bump. Sometimes the market will stop there and decide whether or not it can get through it. Usually it'll get through resistance. And in a bear trend, support is also a pause, a speed bump. The market usually falls through support. Remember my 80% rule. 80% of the time, an attempt to reverse a trend will fail. So 80% of the time, resistance in a bull trend or support in a bear trend will fail. All right, so we have a possible high of the day, a micro double top with Friday's high, and this is the neckline. We're breaking below it. It's a swing short. If you want higher probability, you wait for a couple consecutive bear bars. Remember, 75% chance we're going to be sideways to down starting by the end of the second hour today. And it might be starting here. Right now, there's a 30% chance we've seen the high of the day. By the close of bar one, there's always at least a 20% chance that you've seen the high or low of the day. And if the context is good, it could be as high as 30%. And this is a pretty good bear bar and pretty good context. So I would say 30% chance you've seen the low of the day. The Globex range was small. And you can see the first 15-minute bar. Here we are 7 minutes into the day. And the bar is more bigger than half of the entire Globex range. We were sideways here for 6 hours, reversing every couple bars, and we're near the bottom of it. And we know there probably will be bars around the Globex low as well. So right now it looks like we'll go below the Globex low. The Globex range is small. It's only 11 points. When you have a small Globex range, the market often goes below the low and above the high. And it can happen in either order. Bears were hoping that this is the start of a big bear trend and that we go all the way down to Friday's low. Remember, the streak is going to end. Now, on the daily chart, we just went below yesterday's low. Right? So do we finally have a pullback? No, because they're going to remove that day. They're going to remove yesterday. So right now, we did not go below Friday's low. Yesterday, Monday, is going to disappear. So it's not a pullback. At the end of today, this bar will be gone. I refer to this as a spike and channel. 3 legs up, 1, 2, 3, and then a test of that high. You'd expect a couple legs down. We have 1 pullback, and this is 2. And very often the market will find support at the start of the channel down here. So we bounce here. Remember, this might be the price level for the sideways to down trading. It might be, we may simply go sideways here. The bears want to totally reverse Friday. They're hoping Friday was a blow-off top and a buy climax and the high for the next couple of months. Probably not. Right? Picking any top or any bottom after just a day or two is a very low probability bet. I've been saying that all the way up on this. I've been saying, here's the daily chart. I've been saying it's climactic, but every one of these tops, no matter how strong, is more likely going to end up as a bull flag and be followed by higher prices. And you can see very big bear day, very big bear day, 3 bear days. Yet the market keeps making new highs. We're also at the end of that window. I've been talking all through June how the market tends to rally the last week of June into the 4th of July. And the window that I've calculated is the strongest part of the window is June 26th to July 6th or July 5th. And so we're right at the end of it. Just went through the Globex low. The more bar 2 closes on its low, the more bar 2 closes on its low, the more likely we've begun a bear trend. But that tail on the bottom of 2 will reduce the number of traders willing to sell a close of 2. So probably always in short, consecutive big bear bars or consecutive bear bars one with a big body and closing on its low, near its low, bar 1. So, and we have consecutive closes below the moving average. So we're always in short, but that tail in the bottom of 2 reduces the chances that this is the start of a big bear trend day. If we break below the bottom of the wedge, the next target is the bottom of the most recent buy climax, which is down here. I mentioned last week that I went short around 42.86, and I still am short. And I had an order to sell the open today, so I added to my shorts today. Now, when I went short, I was hoping the market would go straight down, and it went down 20 points. I wanted 50 points, so I held short. And now, with the market so far above my original entry price, I'm more interested in getting out around break even. When you're shorting a strong trend, for me, what I tend to do is I take a trade where I think I have a decent chance of making a decent profit. I'm not looking for a bear trend. I'm looking for a trade down. And if I stay short and the market, as the market goes up, and if I add on, which I've done, then I'm more inclined to try to get out break even. And I'm still willing to sell higher. So if we get up near 4,400, I'll add on. With any of these trades, especially counter trend trades, I trade really small. And I never will risk more than 1% of my total trading account. Therefore, if I win, I don't make a lot. But that's the flip side of if you're not going to lose a lot, you're not going to make a lot. I'm more willing to hold bigger positions in the direction of the trend. So for my longs, I'm much more comfortable. And for my shorts, they're just trades. When you have the consecutive bear bars, one big and always in short, consecutive closes below the moving average, bears want to sell. But because of the big tail on the bottom of 2, that tells you that a lot of the bears bought back shorts. And therefore, when the market is low, bears are buying. And in a strong trend, bears are willing to sell at any time, including at the low. If you see evidence of them buying at the low, then the trend is less likely to be strong. And traders are more interested in selling pullbacks. So instead of selling at the low of bar 2, they will have bears looking for a bounce. And some are selling the close of bar 2, which is here's the daily chart. You can see yesterday is still there. I'm going to reload the data and see if they get rid of it. They are going to get rid of it. But here it's still there. Monday is still there. Usually it's gone by the end of the second hour. Low 1, we're always in short. We have a bear bar closing near its low. It's an inside bar, so you'll get some bears selling below 3, but we're at the start of the channel, which is a support level. So anybody selling here is selling for a swing because chances are we're going to bounce here. Spike pullback channel, and typically the market tests to around the start of the channel and then bounces and forms a trading range. The result could be a head and shoulders top. So we could have a double top for the left shoulder, a double top for the head, and then maybe bounce over the next hour or two and form a lower high major trend reversal. With that in mind, you might get some traders buying below 3, taking a chance that this is the bottom of a trading range and not the start of a bear trend. This happens all the time. You get something and you think it's really bearish and the market goes up. All right? It's because at any given time, there are a certain number of traders who are bearish, and there are always going to be a certain number of traders who are bullish. And no matter how strong a rally is, there are always going to be people willing to sell. And no matter how strong a sell-off is, there are always people willing to buy. So for the bears, reasonable to get out of shorts above a bull bar, maybe bar 4, or a point or so above a bear bar 3. And for the bulls, Can you buy above 4? Is it like bar 4 yesterday? Context is different. Today we have 3 bear bars, decent sized bear bars. So I think this is probably going to be a minor reversal. Remember what I said on the open, that chances are we're going to get a couple hours of sideways to down trading starting by the end of the second hour, and it can start at the open. And it looks like it started right with the very first bar. So 4, rather than being a double bottom 50 and a resumption of the bull trend, more likely is the start of a bounce in the trading range. So probably, I'm saying, you have to be expecting a couple hours of sideways to down trading that could start on the open, and it might have started below the Globex low, below the 50 low. That was the start of yesterday's channel, and the typical market cycle is a breakout like here, and then a channel, a weaker bull trend, and then a trading range. A sell-off down to the start of the channel, and then a bounce in a trading range. And then after the market's in the trading range, traders decide if the bull trend will resume, will we go up, or if the bull trend has ended, and will a bear trend begin? Will we get a lower high major trend reversal, head and shoulder stop, and continue down? That process might take a couple hours. So in other words, we could go sideways for a couple hours here as traders decide. Is this a top, left shoulder, head, right shoulder? Are we starting to get lower highs and lower lows in a bear trend? Or are we going to remain sideways all day? Or is this double bottom going to lead to resumption up? The bigger the tail, okay. So that's an okay bar for the bulls. It's similar to 2. 2, we had a pair of bear bars with a fairly conspicuous tail. And here we're outside up, and we have a micro double bottom 2 and 4, and a failed breakup below support. All good for the bulls, but a fairly conspicuous tail in the close of 4. And if it's not all that bullish, you'll have fewer bulls buying here, and they may end up getting overwhelmed by the bears. A lot of times you'll get a bear channel below the moving average with a lot of bull bars, and there ends up being more traders selling the close of the bull bars 4 than buying, and you get a bear bar after the bull bar, and you just start to work lower. Bear channel a lot of times has a series of bear channel. A lot of the times it's just a series of strong bull bars with no follow-through buying and then a new low. A lot of times you get a strong rally to the moving average, and traders sell bull bars closing near the moving average. Strong rally, they sell. Strong bull bar at the moving average, more traders sold the close than bought. Sideways to up to the moving average, and then a bull bar near the moving average. They sell the close, sell the close, bull bar, sell the close, bull bar, sell, sell, sell. And the result is you get a series of lower highs and lower lows in a bear trend. This is what the bears want. We're probably not going to get that. We're probably going to get what I said, a trading range. So here we have a low 1 sell below 3, and there were more buyers than sellers below 3. And now we have an outside up 4 and a double bottom 50, and there were more sellers than buyers on the close of the big bull bar. So what do you conclude? You conclude that the market is more in a reversing mode than in a trending mode. And you also conclude that limit order traders are making money. We have something bearish, a low 1, and bulls bought it. We have something bullish, a big outside up bar and a double bottom, and bears sold it. And what else do you know about that? So yeah, traders are entering with limit orders, buying below 3, selling the close of 4, but what else do you notice? that they're taking quick profit. There's no follow through. So they bought below 3 and went up and they took profits. And went up on 4 and they sold the close of 4. And will we continue down? I suspect not. I suspect that it'll be a 1 or a 2 bar sell-off, and the bulls will take profits and the bears will buy again. So it might be a limit order start to the day. I just noticed on my other computer, I still have the 5-minute bars from yesterday. I'm going to refresh that data and get rid of those bars. Yep, they just went away. All right, so now we have another low one. We have a new low and a pullback. You can call it a low 1, you can call it a low 2. I would call it a low 1. We have a new low 4 and then a pullback. 4 is a pullback. 5 is the sell signal bar. But we have 5 sideways bars here at support. That will reduce the number of bears willing to sell below 5. So anybody selling here is hoping that this is the start of a bear trend. They know it probably is not, but the math is okay, because if it's a bear trend, we could easily fall 15 points, and they're risking 4 or 5 points to make 15 points. So even if they only have a 40% chance, it's a profitable strategy. I'm going to turn the screen off for a second. I want to show something. All right, I have it set up. Okay, I just took a screenshot of my other computer, and you can see how yesterday, well, this is Friday right here, and this is Monday. So Friday, Monday. Here's my other computer. Here's Friday. Here's the end of Friday, and then it still has all the data from Monday, and then this is today. So Friday, Monday, Tuesday, and here we have Friday, Tuesday. And that's a common thing. I don't know if it's TradeStation or the Merck or whatever, but you can see we still have Monday on the daily chart. And here on my other computer, we still have Monday. But if I refresh the screen on the other computer, let me do that. Yeah, all these bars just disappeared. So this is just one of the odd things that happens the day after a holiday. The TradeStation, I don't know, maybe the Merck, they show on the 5-minute chart the holiday bars, and then an hour or two later they remove the bars, and you end up with this. So here's Friday, here's Monday, here's Friday, here's Tuesday, and here's Friday, here's Tuesday, and Monday is in the middle, and they get rid of all those bars. And they'll do the same on the daily chart as well. Here's Friday, here's Monday, here's Tuesday today, and they will remove that little bar from yesterday at some point today. So a low 1, bar 3, they bought it. Low 1, bar 5. And there certainly are a number of bulls buying. Here we have a sell signal. We have a bunch of bear bars since 78, but we're at support, and the day after a very strong bull trend day. So chances are, instead of going from bull trend to bear trend, we have to go to from bull trend to trading range, and then after a trading range, the bears have a better chance of a bear trend. Well, the bulls, 6 is another reversal up from below the 50 low, so a possible bottom of the trading range. And for bulls to buy above 6, they'll want a good buy signal bar. They'll want a decent bull bar. And for the bears, they're on a low 1 sell below 5, but they want to break below 4. They want to start to see bear bars closing on their lows. We're getting reversals. Down on 2, up on 2. Down on 3, up on 4. Down on 5, and a little bit of a bounce on 6. Reversals create confusion, and confusion usually leads to people taking quick profits. They want to buy low, sell high, and that leads to a trading range. Also, it's disappointing. If you're a bull and you see 4, you're disappointed by 5. If you're a bear and you see 3, you're disappointed by 4. That's another characteristic of trading range, the absence of follow through. Most traders should not trade this. Well, you can argue it's a high 2, bar 3, bar 6, but 3 was a bad buy signal bar, and 6 is a bad buy signal bar. So it's still more limit order scalpers, buying below 3, buying below 2, buying below 5, buying below 6, and then taking quick profits. And most traders should not do that. For the bears, they're still short below 1 from the close of 3, below 2, below 5, but not scalping, right? I'm currently flat. If I were not talking, I probably would have sold below 5 IOI with a bear bar 3 and a bear bar 5. But I would be quick to take profits. I would be disappointed that 6 was small and had a tail below. So I'd want to start to see bars closing on or near their lows. Next target is the bottom of the breakout, the most recent breakout, which is there, 37 low. Big breakout. If we get here, then we've totally reversed the breakout. Bulls want a micro wedge, 2, 4, 7, and the bears want a breakout. We tried to bottom 4, and the bears want to break out below the bottom. The more bearish 7 is, the more likely we'll go down. So the bears are hoping for a measured move down based on the height of the range, or simply based on this today. In either case, they want to get down here, and the bulls are trying to prevent a bear trend. They want a trading range, and then they hope to get some kind of a base within the range, like a double bottom, and then get a resumption of Friday's bull trend. Does it sell the close? I think it's really not ideal. Obviously, we're going down, but this kind of a bear trend where you're getting big bars and small bars and reversals and tails usually is not going to continue as a bear trend. Normally, you're going to get some kind of a reversal. And therefore, it's easier to sell with limit orders on rallies, like sell above 3, sell above 6, sell the close of 4. And that's something most traders should not do. So sometimes you'll have a trend, and it's just really hard to get into the trend because the trend is not as strong as you want. Can you buy above 8, wedge 2, 4, 8, 3 legs down, 79, 2 and 8, but it's also 3 consecutive bear bars. We're very close to the magnet 37 low. We should get there. So that's another reason why bulls will not want to buy above 8. If 8 ends up as a very big bull bar closing near its high, you'll get bulls buying. But otherwise, I think most traders know we're going down at least a little bit more. Remember 60-minute chart? What did I say? I said 70 bars without touching the moving average is extreme, very extreme. And, this kind of thing, I don't remember the last time it happened, but it's the kind of thing that happens less than once a year. It might be once every several years. And therefore, I've been saying that we're going to get to the 60-minute moving average either today or tomorrow. If we fall sharply, we get there today. If we go more sideways like this, then we'll get there tomorrow. Bulls trying to buy above the 37 low. So theoretically, when you have these kinds of breakouts, and you buy for any reason, you bought here, you bought here, you bought here, who knows, you bought any reason, you're looking for a place to put your stop. Some people put it here at the bottom of the channel. and at a higher low. Other people will put it below the bottom of where the market became very bullish, and they're buying more right here, just above that 37 low. They do not want their stop to get hit. But that low, one tick below the low, is a very important magnet. And we're very close to that magnet. And if you're holding a piece of metal close to a magnet and you move it a little bit closer, at some point you cannot fight the magnetism. The metal gets pulled to the magnet. And it's the same thing here. When you're really close to an important magnet, it's really hard for the market to escape reaching the magnet. So we should get to that 37 low. Bears, I'd get out above the bull bar if it closes above its midpoint. I think you can also get out a point or two above any bar, including a bear bar. And for the bulls, it's a possible low of the day, but it's a low probability bet. So if you're taking a low probability bet, you need a big reward. And therefore, it's not a scalp. Anybody buying above 8 is hoping that this is the low of the day and we go up here. You need high probability, you need big reward to offset low probability. So it's a low probability bet that this is the low of the day. Maybe at the moment, maybe 30%. If you're taking a trade that has only a 30% chance of being successful, you need a big reward to create a profitable strategy. Bears trying to keep the bar small, and they're trying to put a conspicuous tail on top. So it's an okay bar for the bulls. Reasonable for bears to exit above 8. Some bulls will buy. I'm not going to. We're so close to the magnet, and we've only had 2 bull bars in the first 8 bars today. Chances are we're going to get down to that magnet. What happens if 8 ends up as the low of the day? What happens if this is the start of a big bull trend? Let's say you do not take the buy. If it's going to be a big bull trend, it'll become obvious. It might take 2 or 3 bars to get obvious. It might take 5 or 10 bars to get obvious. But at some point it gets obvious, which means the probability is higher. Here, we're just above an obvious magnet, and that makes the probability low, buying just above support. It's better to see it fall through support and reverse up. That would be a higher probability buy. Bulls trying to get a micro double bottom, down on 7, up on 8. Down on 9, and they want up on 9 or up on 10. That would increase the probability for the bulls. We're getting near the end of the first hour. Traders are starting to think about how the first 60-minute bar will look. The more bearish, the more likely we're going to get down here today. The less bearish, bigger the tail, more likely we'll go sideways like this, and then get to the moving average at the end of the day or then tomorrow. But we're going to hit this line today or tomorrow, either by going down or by going sideways. The micro double bottom slightly improves the probability for the bulls. Wedge 2, 4, 8, 3 legs down, a wedge 80, 84, and 8, and a micro double bottom. But we should get below that red line, the yesterday 37 low. Can you sell on a stop below 8? 8 is a bounce in a bear trend, and therefore it's a low 1 sell signal bar. But it's a bull bar, and limit order bulls have been making money. They bought below 3, bought below 2, bought below 5. In every instance, they were able to make money. They buy below, buy more lower, and then when it gets back above the breakout point, they get out break even on their first buy, and with a profit on their lower buys. 8, another example. I suspect there are